It's one of the few parts in the tiny bits of the market where still retail investors might still have an edge.
So I like to either make money or learn something, ideally both.
I'm willing to go for a 3x return, and I'm willing to accept 100% loss.
Good morning, good afternoon, good evening, and welcome to Theta Live. This time with earnings trades as the topic. And yes, it will be run from 3 different time zones with the guests from both USA and Europe, and myself currently in Da Nang, Vietnam. We are in the middle of the earnings season, and boy, can that be exciting for an options trader. Hence the topic for today's Theta Live. I'm John Sandvan, who runs the Theta Profit YouTube channel. I have a long career as a journalist and communications manager before I took an early retirement last spring. And now I spend my time trading options and running this YouTube channel. Let's bring in the 3 guests. All are experienced in trading earnings.
Hello, everyone. My name is Daniel, and you might have seen another video I've done with John, so I will keep it very brief. I'm an options trader, and I've specialized in volatility tradings, and one of these trades are especially earnings, and I'm very happy to be here.
Christopher from Vienna, Austria, just south of Germany, 2 countries only divided by a common language, as they say. And I've only started trading options seriously about a year ago, but very quickly actually switched to full-time to it. And I might approach trading maybe a little bit different than many others, because I'm on the belief that you can always make more money, but you can never make more time and learning. So this is what I focus on in how I trade. And this is also why I like trading earnings.
Hi, my name's Eric. I live in Utah in the United States, which is about the same size as the United Kingdom, but it has only 3 million people. I retired from my long business career 3 years ago, and I taught myself to trade options since then. While I was working, I was a long-term investor, so I come to it from a perspective of having a long-term portfolio as well.
Thank you. And both Daniel and Christopher and Eric will soon present how they each trade earnings. But before that, a bit of practical information. First of all, this live stream is organized in cooperation with Earnings Watcher, a platform that helps options traders identify the best earnings trades. It's an amazing tool, actually, that builds on historical data of how different stocks have behaved around earnings events. So I do recommend that you check it out. Earnings Watcher does offer a 33% discount on their annual plan for the Theta Profits audience. So you find the link to the discount in the description and at the moment also on the screen. Let's get to the presentation. And the first one out is Daniel Nikolaides from Germany. And I've asked him both to give some kind of an overview of earnings trades, but also, of course, how he trades himself. So, floor is yours.
Thank you, John, and hello, guys, again. And I'm very happy that we do this. The 3 of us here, because you get multiple views, but let's dig into that, what we are doing in earnings and why it is so good to trade earnings. And I just put in the most basic information for those who haven't done earnings, but maybe some information for others who have been trading and earnings and want to take the next step. So what are earnings really? Basically, not a directional bet. They are a scheduled event, and options don't price the direction really. They just price how far the move would be. Maybe you've heard of the expected move. I've talked a lot about the expected move, but with earnings, the expected move is what the market expects to react to. And the problem is that a lot of long-term investors, especially institutional investors, they want to hedge their portfolios, and that's why you normally you don't trade earnings. A lot of people just sell puts, because puts always have more premium with them. Here you also have market makers, and implied volatility spikes up. I don't want to deep dive what options are. I think you know that. That's why I just assume you know what implied volatility is. And due to this rising, so the risk premium, we can trade this volatility because we have a very temporary, very short window where everyone is focused on that stock, and basically you can take advantage of that. It's one of the few parts in the tiny bits of the market where still retail investors might still have an edge, basically, and you can get some premium out of it. You asked to do a very general, give a general approach, and basically I mostly trade short vol volatility. We'll look into that, but I also do long volatility trades, especially going into earnings, IV rush, or 2 weeks out sometimes, especially to hedge my portfolio with it without buying VIX options. What we want there is if we have an expected move, let's say of $10, and we've seen in the past that moves 12 in average, and we see the positioning accordingly. We would want basically to go long vol. So we trade out of the expected rules. Short vol is the other side, which is maybe the easier trade if you calibrate right, because what you always have, implied volatility rises. That's why the prices go up of options. So IV ramps up, and when the earnings event happens, the results are out, volatility deflates. So that's why you already got part of your premium back, which you have sold there. So you normally do this with iron condors or iron flies. We will look at that, how we do that later. And I love calendars, time spreads. I also do them on the earnings event. I'll keep it simple today. I trade calendars for earnings before the earnings, and sometime if I see a mispricement and believe that the option will be repriced before we go to the earning. And basically, you get paid for fear, but this is what you do normally with options if you sell them. Why short volatility works, we'll deep dive into that today. Like I said, institutions, they buy protection. And in the end, basically, because IV collapses, and you normally, statistically, stay in the implied move with a lot of earning results, you're able to collect this premium, and if you calibrate right, you basically, on the long term, have the mathematical edge on your side. And this is what you want. You don't want to overtrade. You just want to trade the way that the math works. Nothing else matters. And you might have a season which doesn't work out, but on the long run, on 10, 20, 100 seasons, if you have an edge there, and this is what we're going to talk today. I use Earnings Watcher. The easiest thing would be just to see how price has opened and how it has closed, and take this as an average, but Earnings Watcher takes the next step. It looks at the intraday maximum move, and this is what we are afraid of on the one side if we're playing short volatility, because we might get blown out of our position. But if we know what the end move is on average, we can also see that sometimes the move, there's a gap up, and in the end of the day, everything is fine, or we can sit that out. So that's why I look at both of these metrics, but mainly because if you look at options, you should see that there's a risk with it, and you should always look big is the risk before you look at the reward, because the reward is bigger the bigger the risk is. Without risk, there's no reward. And that's why Earnings Watcher shows how the price can run during the day, and that's why it helps us calibrate the right way to avoid blowouts. That's the thing. A lot of wins, little blowouts. And I use a lot of other metrics, and one of the most important metrics for me when I'm setting up earnings trades are looking what the market has positioned itself. So GACS, I don't know if you know about GACS. It's basically the hedging of the market, and where the levels are. I will show you something live afterwards. And I want to know how far the price can run before maybe the move is damped or the move will amplify. We have a level where there are a lot of sold puts, and basically market makers have bought puts, and they will have to do something, and that it will have to let the price run. And this can be very bad for you if you have your positioning there. So this helps me basically look again at my historical calibration and adjust, and also adjust intraday when the earnings event has happened, and I see how the market reacts. And if you have questions on that, we can deep dive into that. But basically, the core strategy is the iron fly and the iron condor, and that's why we calibrate basically the short strikes and see how far we have to go with the long options to collect enough premium, but also basically to be safe and to calibrate not only the move, but also see what the market has prepared for us. We'll put it into a very simple, into three very simple cases, very easy. We have a stock which is trades at 100, and if we have a very strong environment, so basically, even if the earnings event happens in the beginning, we just look at the volatility collapsing, but afterwards these kicks in because a lot of bought and sold options there, and if basically they are at the money at 100, then the dealers will dampen the move, which is good for you if you sell iron flies, and then you just need tighter wings. You don't need to go further out, because the further out you go, basically the cheaper the long options get, but the bigger is basically the gap and the loss which can happen to you. So you always need to basically adjust, and it's not only important to know what happens with the IV brush and how much the statistics tell you what will happen, but you set up, calibrate right before. So management starts before the earnings result. If you have, let's say, I call them walls here, or reaction zones, if you have a lot of hold and bought options at 95 and 100, basically, then you might go for a condor, because even if the stock and the money pay the most, basically you should put your shorts there, because the price is more freely and move more freely there, or will be drawn in, because these zones also mainly react also as magnets and basically as support and resistance, but in a technical place. Basically, if you have a negative or very weak gamma structure, this means dealers will chase price, and that's why I will go sometimes follow the calendar, especially if I look at the term structure before and see that there is a shift coming, and I would go for wider iron condors, maybe 2 standard deviation or 3 times the premium. So without much further ado, let's dive into that, and I will change so you can see what I'm doing here. Hope everyone can see my screen. We're here at Earnings Watcher, and we are at the moves analyzer tab, and I've prepared for you 2 very, very simple and very boring stocks, which explain everything very well. Basically, on the one hand, we have Coca-Cola and we have McDonald's, and I'll try to show how I do that. They don't report this week. I didn't find something which is very easy to show. And I know a lot of people like to follow things, so you have some time to think this through and maybe follow this, not the trade, but the whole idea. So if we are in the moves analyzer, what does the moves analyzer do? You see a lot of other stuff here, but it shows us which moves we did have. So for me, it's always from the big perspective to the small perspective. And in the last years, because sometimes stocks do change. Also Coca-Cola, which is a boring stock, let's say it like that. Warren Buffett stock, if you want, which will pay its dividend, but it doesn't blow out that much. But if we take the longer perspective, we will see it has an average move of 2.9. We go just to the 2 years. We see it's 2.8. It's not any change, but it is for a stock like this, it is a change. If we go back 10 years, you will see it is 2.9. Basically, we know that we'll be doing great if we stick around 3%, and we can collect enough premium there and basically not get blown out. What also is important is to look at how many times the actual versus the implied move, how many times has there been a beat. Look at the last 8 quarters only here. So only 3 times, basically Coca-Cola, the intraday move ended up outside of the implied move. But the good thing with Coca-Cola is if you look basically at the end of the day moves, we can do this here in the drift lab, we can do that later. You will see that it normally tends to drift back into the implied move. So basically even in the morning, if there's a gap up or during the day, you look at the positioning and then you sometimes basically with a little adjustment, you can still get your premium or don't take a loss. This is very important for us to know. And another thing is the move's direction. Does the past tell anything about the future? If you look at history, it does sometimes. You can't always predict the future right from the past. But we know the stock tends to go up. So if I had to skew, I would skew to the upside if I just use this data. But if I also use gamma levels and basically intraday change of the gamma positioning, look at the DAX too. You later what the DAX is, might go and skew more or less. And this is something we are going to do right now. Moving for a very brief minute to another tool I'm using is called ManTheQ. They provide gamma levels and much more. And basically, Coca-Cola is reporting next week, so we will discard this expiration here. So we will be looking at the 13th of February for our expiration. We see here any negative change, which means a bit more destabilizing. But what I'm interested in, where is the high volatility level? So where do we go from positive to negative gamma? This is important, how moves happen, and more importantly, where are of calls which might act basically as a support, as a resistance, and where are a lot of puts which act as support. So this is something next to the roughly 3% we have at the back of our head. This would be maybe possible short strikes we can put our iron condor or our basically iron fly. So let's go back to Earnings Watcher and try to set this up. I know the prices are from this week, it will ramp up. Maybe we will get more premium, but for the sake of it, basically Coca-Cola is a very nice example where we can show you a lot of things because basically it has been a winner for a lot of times. The yellow line, which you saw, was nothing bad. It was something good. Basically, it showed you that this was a strike where there is not a lot of liquidity. And this is a very important part. Liquidity is really, really important because you don't only want to get into trades, you need to get out of trades. And if you pay more to get into a trade and then you can make with a trade, and basically you have already booked a loss. Basically, the easiest thing is to go to the already set and prepared dashboard here. We will go out to the next expiration. Sorry, we need the 13th. We got already. It was smarter than I was. So I told you 3%. So we could sell or straddle here if we would like that. But I like this as a reference point so I know what happens with the fly. I'm collecting $2.50 and then basically you remember the numbers from before. We can look at this afterwards, but let's go to the flies. We find a fly right away which sits outside of these 3% and gives us enough. Maybe not, but let's start with this. It's 2.4, 2.7. You remember I said the 77 and 72 are some good numbers. So let's see what happens here, where basically will be taken out. So 77, we're already quite safe here, and 72, basically this is not that safe. It's something we wouldn't do, so let's clear that out and let's keep it easy. So you see this is a skewed. Basically, we would go to the 80 here. We want to keep it very simple. And there's 77, think of it. And basically, we put yes. Click here. Very sorry for that. And then click 2. This looks a bit better here. So basically, we don't have much room to the upside. We would again adjust that. Basically, we have a high likelihood of success. We have a lot of even on the downside. And basically, we see the risk and reward is not that good. So that's would have to adjust that. Basically, I don't want to take up the time of the others. This would be a trade I wouldn't take like that because we know 2 things. And that's why it's important to see the things. Just don't take numbers and put them in. This is a trade where we know how the market has positioned itself, how it would react. But this is a trade we would have to adjust because historically, we normally tend to go to the upside. So basically, I would try to go with the 3%, move on the upside, and maybe to only a 2% on the downside. So we would collect a bit more premium and we would be more safely.
Thank you very much, Daniel. I did put out another live poll, and we'll take just a very quick look at that one. The results there. We asked, how do you usually approach earnings? Well, the big majority here is still figuring it out. So I hope that this session will make it easier for you. While there is about 1/3 who is saying that they have no directional or volatility plays. So that's a bit about that. Let's bring in you now, Christopher, and hear how you trade earnings.
Yeah, gladly. Thank you very much. Maybe very short about my background. So I was into options and trading actually already 20 years ago. However, there were not really any platforms back then. And when I studied, there was basically a coin flip between computer science and risk management. So when I flipped that coin and ended up 20 years in software development, but was lucky enough to start a company and have a quite successful exit. Stayed 4 years there, built that department up for the new buyer. And I had a quite comfortable job, but it was not so satisfying anymore when I found trading for me and switched to trading full time last year, as I said. So for me, it's maybe not as experienced as the other 2 speakers, but I have a very distinctive approach, I think, here, because I always want to maximize my time. And this is also why I like trading earnings a lot, because earnings basically give you an opportunity to trade in a very accelerated market. So I like to either make money or learn something, ideally both, but I would even take learning something above making money. And earnings is just you put on one play. I do mostly short roll the night before, or the day before, and you're out the next day, and it's high volatility. There's a high implied move. Something is going to happen. Options are priced accordingly, and it's just a great accelerated learning place. The buying power lockup is very short, only for the duration of the trade, but, and that's maybe also why not that many people in the audience trade it as much. It actually takes quite a lot of time to figure out what play to put on, what are the right earnings, what's in your favor, what's not in your favor. It used to take me a lot of time to research the IVR history, the term structure, and so on. So I then didn't play it as much until I started using platforms like earnings watchers that give me that cut down the time on this research a lot. So what do I trade? I'm mainly trading short vol due to all the reasons that Dan said. Get paid for taking risks, and in short vol long theta plays, this is typically where the risk is higher, and therefore you can get paid a bit more for taking on those risks. But I actually do not trade the iron condors or iron flies, because my main trading is on Interactive Brokers, which is a quite high fee broker. And if I trade a narrow iron fly that might have a great probability of profit, but basically I'm hoping for $10 of profit for like a trade with $4 of commissions already. I'm already fighting quite the uphill battle. Of course, the changes depending on your broker and your commission structure, but I'm looking to have as a few legs as possible. I also want to have basically the maximum P&L, so either full losers, 100% losers, 100% winners, because that also limits the impact of commissions and fees on my position. And also the higher stock price, the better, because the fees typically are based on the number of lots and not on the price. And the price of the option typically goes higher with the stock price that's higher. So by process of elimination, that basically narrows down to mostly a calendar structure, as I don't like to sell short strangles, as I don't like to have undefined risk on earning plays. I do that maybe on futures, but not here. So my weapon of choice is the call calendar, my default. So that's basically where you sell a shorter dated option that's directly after the first expiry after the earnings announcement, and you buy a longer dated option. By default, I typically look at the money, a calendar structure with as long as it's the same strike, 2 to 4 weeks later, and then adjust it. If I have some incline of I just want to be a little bit higher, a bit lower, I may adjust the strike price. And also I change that to a pick 2 weeks, 3 weeks, 4 weeks based on the liquidity. Often that I would go for the monthly expiry, which is often more liquid. What does this look like? Yeah, the calendar spread is, in contrast to an iron condor or fly, a short vol play that you pay for. So it's actually usually a debit trade because you pay the difference between the longer dated option and the shorter dated option. Since the longer dated option is usually worth more because it's longer out in time, you pay the difference between those two. And it also turns out that this is your max risk, which is always important in terms of sizing, to look at your max risk, right? What you want to happen is for this value difference between those two to widen as much as possible. This can happen by either the short losing a lot of value while the long keeps it, or both gaining value, but the long gaining value more. So this is what we're looking for. As an example, this is a trade from Monday to Tuesday. So Merc had earnings Tuesday before open, and I put on a call calendar. This is an example where I actually put it out on a little bit higher. I thought it's more likely that Merc will go higher than lower, but it doesn't really matter. I will show you also the result if you would trade it at the money. And I have the 120 strike with a short expiry was this Friday, and the long 2 weeks after that. And now the most interesting part is covered up. I'm not sure, John, if you could remove the questions. Thank you. So what I want to show is down here, we can see the two different IVs. So we can see the front one for this case. When I put it on quite early because I didn't have time later in the day, was at 54% versus the later one is 31%. And then I took actually another screenshot just before market close on Monday, where you can see also how much this volatility even rose throughout Monday. So this was basically 4 hours later, it went up from 54 to even 64%. So this is also Dan shortly mentioned the term structure that I look for to give me more conviction in the trade. The higher the ratio of the front month IV to the back month means the more overpriced the front month is. And we expect all these shoes to come out once the earnings happen. So remember the day before earnings, 64% and 33%. What happened? Well, there was an earnings announcement. It didn't look too well. It was here. It looked like the stock went down. Market was disappointed. I was convinced, okay, so it's going to be a full loss. But as often things turn around in earnings, it jumped up in the first candle and directly into our profit. Funnily enough, throughout the day, it actually came back down to, I think, almost half or like a third of that price, which is also very fun why I like to play earnings, because it's just not one move, but often it bounces around and it gives a lot of opportunities to make money. So in this case, we can see not only did it move into my hands, would have mattered that much, but the front IV halved. So we went from 64% to 32%, the back month from 33 to 22. So basically the front one halved. So it was the overprice was reduced by half, and the overprice of the back one was only reduced by a third. And this is what gives us a lot of money back there. So this is how I closed it out. And what I like is I put it on. It was very clear. I put on my calendar. It took me maybe 1 or 2 minutes. Next day I saw that. I took it off, and taking the screenshot for the presentation today took me more time than the whole trade. So the return on time investment is really good. The return on mental headspace investment is really good. And this time it also worked out that the profit was actually quite good, over 100% from what I could lose. So I think that's my 8 minutes up. Maybe just one more thing. I love the calendars because I can use them in a lot of other trading that I do. They are very complex beasts in practice. It's never like what the models tell you. It learns. I also like to do diagonals if liquidity allows, and I use it a lot in, for example, my SPX or my weekly trades, index trades, and so on. And earnings is just a great way to have this accelerated learning how calendar structures and diagonals actually behave.
Thank you very much, Christopher. And we had another live poll out there, and that's really where we ask, which earnings strategies do you trade most often? Well, basically, people are answering either iron condors or calendars, as you just reviewed, Christopher. Were you surprised about these results?
Yeah, I think those are the most straightforward. Iron condors is what a lot of people know, and basically the non-directional stuff, that's also not surprising how it turns out. And calendars, because they have a lot of upsides in terms of what I just explained with the IV crushed of the front month.
All right. Thank you, Christopher. Let's move to you, Eric. How do you trade earnings?
Well, thank you, John. I do everything that Dan and Christopher have already mentioned, but I tend to take more directional plays. As I mentioned earlier, I've been a long-term investor for a long time, and I've got about 75 stocks in my portfolio, and I know quite a bit about all of those companies. I read about them, I follow the earnings reports, I listen to the conference calls, and so I frequently have a directional bias. And in those cases, I will either buy put spreads, buy call spreads, sell call spreads, sell put spreads, because I'm comfortable with bigger swings. I'm willing to go for a 3x return, and I'm willing to accept 100% loss. So that's probably not something that most people are going to be doing, but that is one of the things that I do frequently. I also love to follow Dan's trades on Earnings Watcher, because he does all the hard work, and all I have to do is decide whether or not I think that his thesis is correct, and then I can follow along. We didn't talk too much about IV Rush, so I want to talk about IV Rush. This is when you buy a straddle or a strangle prior to earnings, because you expect the IV to increase faster than the theta will hurt your trade. And Earnings Watcher does a great job of modeling that, and it gives you an opportunity to make somewhere between, say, 4 and 10% in about 3 hours. And that doesn't sound very exciting for someone who likes to, swing for the fences. But if you think about the fact that T-bill, the risk-free rate of return is maybe 4% per year, then you can make between 4 and 10% in 2 hours. And you can repeat that, say, 100 times a year with maybe a 75% success rate. That is a very, very interesting way to trade. And your risk there is very low, because as long as you get out before the earnings announcement, I mean, maybe you're looking at somewhere between a 2 to 5% loss and maybe a 4 to 8% win on average. That becomes a very interesting way to trade, and you can take a much bigger size there because your chances of losing a lot are very, very low. So it's quite fun to enter a trade at 4 hours before the close, and then close it out for 5% 3 hours later. and just continue to rinse and repeat that. And since Earnings Watcher is part of the sponsorship of this program, I want to mention that if you're new to earnings, this is a great product because there's a daily video where the best trades of the day are explained on YouTube and in Discord, and you can interact with other people on the show and talk about the trades. And that gives you an interesting way to learn if you are new to earnings. And there's a paper trading feature and all sorts of other things that are very interesting. Now, I know I'm much briefer than my colleagues here, but I don't want to restate what they stated. All of their strategies are very smart and very valid. But mine is more, I like Ivy Rush, and I like to take directional bets on the 75 or so stocks that I follow closely because I think I have an edge there. As a retail trader, I don't need to swing. I can get in and out quickly because I'm not buying thousands of contracts. You buy a few contracts, stock goes the way you want it to go, you close it out, and you move on to the next one. So I'm going to keep my comments very brief so we can hopefully have some questions from the audience and try to answer the things that are specific to the people that are trying to learn from us.
Thank you, Eric. We have, I added another poll, and not so many people have answered, but the question is, what's your typical max risk per earnings trade? Less than 1% of the account, 1.3% of the account, or more than 3% of the account, or you don't have a fixed rule? Well, seems like most people are at less than 1% or 1 to 3%. But I thought we could start off with this, running this question with those of you in the panel. Let's start with you, Eric. What is your rule for how much risk you are willing to put on each trade you do?
So that's an excellent question and a good one to discuss. So I think about my portfolio in two places. I have the big portfolio that is a long-term trading that is separate from the options portfolio. So the vast majority of my funds are long-term investing. So just from the options portion of the portfolio, on a directional trade like those that I like to do that I mentioned, I'll be somewhere between 2 and 4%. Because if it gets blown up and goes to zero, I don't want to be crabby to my kids and nasty to my wife. I want to be able to accept the loss without any trouble, and I don't want to lose any sleep over it. If I'm doing something like an Ivy Rush trade, I might do 10%. That trade that I mentioned earlier, which is maybe hold for 3 or 4 hours. Because if I'm doing 10% of my options portfolio, but my probability of loss is maybe 2% of that 10%, I'm not too worried about it. So it depends on the type of trade. If I'm doing a calendar like Christopher was discussing, I love those as well. I'll probably be in the 2 to 3% range. It also depends on my level of confidence. If it's something like Disney, which I'm in now, which I was pretty confident about last week, but so far I've been wrong, although it's doing a little bit better today. That's maybe a 3% trade because my belief was that Disney would not move on earnings. I was wrong. It went down 7%, and now it's recovering a little bit today. So I still think that trade's, right now it's slightly profitable, about 50% profitable. So that's how I think about percentages.
What about you, Christopher?
I'm a lot lower than that. So first of all, the calendars tend to lend themselves either to 100% loss or 100% profit or 150% profit, anywhere in between. So always assume there's a good likelihood that money is gone when I wake up tomorrow, more or less. And I'm in the nice situation that I have, probably quite substantial capital. So I'm also not really swinging for the fences as much and more in the preservation mode. I also have various trading accounts and LLC trading accounts and retail accounts, and they typically go way below 1%. I don't think I've done an earnings trade above 0.2% max risk on that account, not even on all the accounts put together. simply because I like to play all the statistics and the numbers, and I like to trade small and often, but if I don't trade often enough compared to, I don't know, I do like 150 zeros a day, and I don't know how many futures and so on, I can go a bit higher. And if I lose like a full 2% with all my other trades, that's a bad day. So I'm not willing to spend 2% on a single trade, on a single occurrence of a single night, on an earnings trade. So that might be small, but if you do 2, 3, 4 earnings plays around every week, and you risk 0.2, 0.5, or even 1%, that's still a lot of money, a lot of risk at the end of the year.
Daniel, what is your rule?
Basically, with most and all of my trades, basically, I would go for 2%. And if I have more confidence, and especially with the calendars and other things I can adjust, and there I would even go, if I know I will do a lot of trades repeatedly, I would even go to 6%. I wouldn't recommend this to anyone who hasn't been able to adjust that and to have a decent win rate and to have mathematics on their side, because you might have 1 or 2 seasons which don't work out. So keep it to 1 to 2%. Would be my advice. And if you feel more confident with your strategy, maybe after 1,000 trades, maybe move up higher. Earnings are one of my core volatility strategies.
All right, so let's go to the questions. And we have a few questions already in, but we'll probably have time for more than the ones we have. So just go to the Vivox app and use this session ID 154982335 to ask your questions. And it's great if you are clear, if you are addressing it to one particular in the panel. The first one, that is a pretty long question, but I will just try it from Eduardo Lu, and I will try to read it out. For those of you who trade short volatility, for instance, the IV crush, number 1, do you typically let the position expire, or do you try to close it after the event? I have often found it difficult to exit after the earnings announcements due to wide spreads and low liquidity in certain legs. Question 2, I estimate that the minimum annual data cost required to run this strategy is around $3,000. Does that align with your experience? And 3, on average, how many events do you trade per earnings cycle to diversify the tail risk exposure? Do you avoid trading highly correlated tickers, for instance, banks like GS, MS, and JPM, and instead select only one from each group? That was 3 questions. I hope you can remember them. Who would like to take a stab on this one?
I'm happy to answer all of them, but I've already forgotten what they all are. So if you could ask them one at a time, I'd be happy.
All right. So first one, do you typically let your position expire, or do you try to close it after the event? You know, if you tried short volatility.
Never allow it to expire. Always close it. As you get down to the end, there's just too much gamma risk, and any crazy thing can happen. There can be a tweet from the President of the United States. There could be a crazy sell-off in software stocks where they're all correlated, like we're seeing now, for no reason. So you don't try to squeeze the last bit out. When you've made a profit and you're happy with it, take it off. Don't be a pig. Pigs get slaughtered.
And his second question was, I estimate that the minimum annual data cost required to run this strategy is around $3,000. Does that align with your experience?
Is that for one trade or multiple trades? I'm not sure. I think that it just depends on, how much money you have and how much money you can comfortably put at risk in the market. You never want to invest money that you need to eat or live, because if you do that, you'll be running scared all the time and you're guaranteed practically to blow yourself up. But you can put on a trade for $100 and you can do a lot of them if you want. It just depends on your situation.
So that question was about the data costs, which doesn't really I think $2,000 is roughly what you pay if you want the historical options data of US stocks. That's around $3,000 if you want to do your own backtesting, for example.
Oh, yeah.
I think this is what the question is getting at. I don't do that because I'm not running my own backtest and buying all that data. I'm rather looking for other resources that have done some research. I basically only look for two things. One is the history IVRV, and actually use things like market watches, which doesn't cost you $3,000 a year in order to get that. And the other thing is the term structure, which you can get for free in lots of tools.
The third question was about diversification of the risk. How many events do you trade per earnings cycle to diversify the tail risk exposures? Do you want to add something on that one as well, Eric?
Sure. I think that if you have an understanding of banks, as the caller's question suggested, there's no reason to diversify. If you think you understand the banking world, trade a lot of banking stocks. If you think you understand chips, trade a lot of chip stocks. But again, I come from that as a perspective of I have understanding of the specific companies. So I would not think about it as diversification. I would think about each event individually. Each trade is different. Each setup is different.
Is there anyone else who would like to add something on the questions that Eduardo asked?
Yeah, so for the last one, also I don't really diversify that there because I'm trading the volatility and doesn't really matter the sector. However, if you would go with directional plays, for example, those tend to align. So the banks all go one after each other. If one bank has a nice earnings report and the market reacts well, all the other banks typically go in the same kind of direction. That's not the earnings plays that I do, but if you go in those directional plays, then yes, you should diversify. Meaning how I played it in stocks, I actually go to all the different banks if I want to be in banking, but the whole overall position is like my one position that I want to have.
All right, I guess we will move to the next question, which is from just a moment, which is from Peter. Which earnings events over the next week do you pay the most attention to? Anyone with some good tips of what is the best earnings trades for the next week?
I'm not there yet. I can tell you what I'm going to do when I get off this call after I see what's been happening with my open positions. I'll go into Earnings Watcher and I'll take a look at the calendar and I'll look and see what's coming up. You can, you sort by day, you sort by before market earnings and after market earnings. You look at the expected moves, you compare that to your viewpoints, and then you move forward. So with respect to my earnings trades, I'm going to be doing the work for tomorrow, today, and the work for Monday on Sunday, and like that. I don't go too much further, so I don't have any hot tips for that questioner.
Anyone else?
Yeah, basically you can look if you want to do the short ball and McDonald's. I told you about these are boring ones, simple ones, and it's not about tips. It's what Eric said. I do a weekly preparation, and Earnings Watcher makes it easy to do that. But even more importantly, you should always, before you set up the trade, and always have the trades in the last hour, 15 minutes of the day, and I will also try to close them in the beginning and run if I see some directional profitability there. The thing is, you should do your preparation if you have the time, but always check the actual data because things change, positioning change, and the option flow change. And something you saw here on this video might not be valid next week. So always be on jour with these things, and yeah, try to have basically data when you set up the trade. not get lured in.
The difficulty about planning ahead for next week is that the market goes crazy on its own every day. I mean, if you were planning on software stock earnings trades for next week now, you're getting run over in the last 4 days, and the whole marketplace is going to look different in the next day. And as a general rule, I would say their suggestion, I think there are a lot of beaten up software stocks now, so I would be looking for those that I think are likely to bounce, because everything's gone down, but they're not all going to be destroyed by AI in the next 3 weeks. So there are going to be a lot of opportunities there. You just have to figure out what those are. But if you'd asked me that question last week, I wouldn't have been able to answer it, because those software stocks hadn't started to get beat up. That's at least not to the effect that they have this week.
I had deployed a lot of capital yesterday.
In that same idea?
Yeah.
Excellent. Excellent.
Any tip from you, Christopher, on this?
So this is why I like the earnings plays a lot. There's not a lot of preparation that I do nowadays, so I don't need to spend a lot of time. I can actually show how it is, how I work. Basically, I go to just before close, or whenever I have time for the day, I just see what's up for tomorrow and if there's any opportunities. And for that, also right now, I'm using actually earnings watches that you also mentioned at the beginning. Either go to the data picks, or I'm at Discord if Dan has something already on the silver platter for me to look at. I'll go to the wall scanner. Then I see, okay, tomorrow is maybe Google, maybe Amazon. Then I look at the IV/RV, and I think somewhere was also the question, how do I know the term structure, right? So the easiest how I do it is just I use TradingView a lot to look at the charts, and TradingView on the side already at the bottom has actually the at-the-money IV term structure right there as a slope, and that shows you quite easily. I don't know if you want to share this. I can show that. I'm sharing it right now. So this is, for example, Amazon that has earnings, I think, tomorrow. So that's something I'm going to look at. And the term structure, we can see it down here. So again, that's like the 78% 1 week and 60% the next week. And I'm looking at the biggest difference here. For me, I would like to see at least a 1.35 ratio. Great is 1.5 ratio, and sometimes you get even higher, especially nowadays with the Max 7 getting 3 expiries a week. There's a lot more things you can do in calendar structures now. I'm actually quite excited for some more plays there. But basically, that's how I would go. I go to Earnings Watcher, go to Data Picks, was gonna see what's for tomorrow. I don't look ahead the day after tomorrow or next week at all. Look at the term structure, go into option strat that I showed also before. Play with the curve that I want to have, maybe even put on a diagonal. See, I want to take off the risk of the, share this tab instead. So go into option strats, filter that out, look at, again, the IVs here, maybe say, I don't like the downside risk, maybe put in a diagonal, for example. And this is, again, something that's just really, really nice. I put it on, and tomorrow it's off. So I actually do let trades expire when they're full losers. Then they just expire somewhere. And I don't care about paying the commissions for the closing of a full loser trade.
I agree with that. I didn't mention that. I try to forget about the losers. You're exactly right. There's no reason to pay to get out of a trade.
Yeah. Although you should then forget about it. So what happened to me, for example, what was it? Philip Morris, I think. I played earnings, what was it, like 2 quarters ago, and they just tanked 15% or something. And it was just gone. And then you start thinking, but I still have, I mean, the short is worthless, the long is worthless, but I still have it. Maybe I can turn it into a Pullman's covered call. Maybe I start selling some shorts again, and it's never a good idea. It's a different trade. You would never put it on in the first place if you haven't had this leftover position. It costs you more. There's no expected value there, and it takes a lot of your mental space. So earnings, look what's tomorrow, put it on, next day take it off, and go out and enjoy the sun if you have any.
All right, we'll get on with the list here. And we have a question for Eric from James Coates. Eric, what is the most common trade strategy that you use for IV rush trades?
I look at Earnings Watcher because I'm not smart enough to model IV rush, but I buy it at the money straddle, and I'll hold it for maybe buy it about I'm trying to convert this to Eastern time. Maybe buy it around noon Eastern time and get out a little bit before the close. Just be at the money straddle. I strictly do IV rush based upon Earnings Watcher modeling. That's the only way I would do IV rush. It's all there, as Christopher said, served up on a silver platter. You just have to look at it. The key with those IV rush trades is you want to make sure that the underlying is liquid, because if it's spready, you're going to pay too much to get in and you're going to pay too much to get out, and you're going to find yourself 5 minutes before the close having to drop your price until you can get out. And so you don't want to do that. So you want to look for ones that are highly liquid. The other thing is that I don't really get interested unless they're modeling 9 or 10% profit, because you want to have a fudge factor there in case the model's wrong. And so my goal is to make 5%. And if I get to 5%, I'll probably just take the trade off, because that's a guaranteed winner. And in the last few minutes, you're never sure what's going to happen.
All right, we have a question that you touched on, Eric, so I will let Daniel or Christopher respond, and that is, should we always avoid using stocks with not high options volume? What say you, Daniel?
Not always. It depends how much you trade. If you see an edge in a week on 20 stocks, and, or 30 or 40, depends, then maybe not avoid it, but we play it very small. But in general, with every trade, not only earnings trades, basically liquidity is king. And I've repeatedly said that. So, and a lot of people ask, when can I get out of trade? And especially in earnings trade, even if the stock doesn't move that much, the prices are wild in the beginning. It's like crazy. It's very interesting to look, and you have to train yourself, well, not to panic, because it's the most important part. You have a plan which you made before entering the trade, and not making a plan while you in the trade. I know it's difficult. Sometimes you have to adjust this. If you know what your loss is, and be able to take it, and especially with these illiquid stocks, those ones, after the first 15 minutes, market makers able to price where you might get more liquidity there. But if you can avoid them, if you find an edge with more liquid stocks, if you are more used to all these earnings trades, then maybe you can get into trading a bit more illiquid stocks. I would advise everyone to avoid everything below to 10K average volume. Might get these ones. I would only do calendars, most of the time with 30 days out. Different than Christopher. I like what Christopher does a lot. Makes a lot of sense, especially if you are a week, play the week after. But always try to look for liquidity, because the calendar you can a bit and maybe sit it longer. Yeah, that would be my approach.
Anything to add from you, Christopher?
So I think the problem for the question is something else. So they had the same issue. Why would you even want to trade this? Isn't there enough other opportunity there? And when I started doing the earnings, I had to do a lot of research. I was doing all the term structure. It took like, I don't know, 2, 3, 4, 5, 6 hours every week as a preparation for the upcoming week. And then I spent all this time, and then I look at the table and nothing looks great. But I already spent 6 hours. What do I get out of it? Let's just take the top 3 ones, right? And just to keep you busy. And we want to trade. We are traders, but shouldn't then still take a bad trade immediately because of liquidity, not the right term structure, anything else. So find also other strategies to scratch that itch, and don't try to figure out how could I make a strategy that has this illiquid stock and maybe do an earnings trade.
Or if you love the stock, buy the stock. I mean, if you can't put it in the options, just buy the stock, and if you're right and it pops 20%, take your 20%.
Yeah, do a ride or die. Just do a put credit spread if you say it's going to probably go up, and just let it expire, for example. But again, there's probably other better opportunities, and I know that you want to trade, and sometimes there's nothing in earnings as well, right? There's a reason why we have earnings even, where you can't even catch up with all the opportunities there, and then there's a week where you better travel to Vietnam and enjoy the beach, right, John?
But yeah, slippage will kill you. Slippage will kill you on the illiquid stocks. If you're losing 10% to put the trade on, and you're losing 10% to put the trade off, you're down 20% before the stock even moves, and that you're just not going to win there. It's too hard.
Yeah. Eduardo has a question for you, Christopher. The bid-ask spread on calendars can be very wide and can easily eat into your edge, except for a few liquid tickers. Do you enter the trade as a single position using limit orders, or do you leg into it, opening one side first and then the other?
I do limit orders and enter it as a single trade. I haven't found too much issue with that, again, because I don't try to trade every stock opportunity when it's, for example, also illiquid. What can happen, and actually the example that I showed with Merc, even though it's actually quite popular stock and quite liquid, I couldn't put on exactly what I wanted. I wanted to put on a diagonal above, actually, but the longer dated option wasn't liquid enough on the strike price that I wanted. So I actually changed my structure a bit, and then I had the liquidity that I wanted with very similar trend to what I wanted. So I sometimes do these kinds of adjustments. As in lagging in, I haven't found much for these kinds of strategies that it makes a difference, because if I put it in, it basically always crosses the bid ask of the two individual ones anyway. And I don't see. I'd rather pay the additional cent or so that I have on the combo instead of the price moving in between.
James is asking, and I'm not sure who this is directed to, please explain further how you select your strike prices on an iron condor, in particular the strikes that define the risk. Anyone?
Dan.
The others would have. I would try my very best to keep it brief. The first thing is, which is most important, for the move and for the preparation, but more important is to look at what has happened in the data. So if we see like Coca-Cola at roughly 3%, so you just try to make the math and say we don't skew 3% up, 3% down, and then if you want to have an iron condor, if you want to do a short straddle, which I wouldn't advise, even on Coca-Cola, you might even fall into that tent. But the thing is, what I do later is basically we evaluate these kind of strikes, the short strikes I've selected, especially for short. Well, you can do the same for the long ones, but you can evaluate them on what the market has positioned itself, so you just know what happens if these strikes are reached. That is the important thing. And yeah, I also did Merc, and basically, and is one of the nice ones. I did it with a different structure. I was late, so I didn't share it with the other users and colleagues. But yeah, I looked at it and I adjusted it a bit during the day, and basically I had live data, so I could basically salvage a bit more because I saw the drop. I could adjust the strikes, and I knew when we went up, there might be a place where this stopped, and I could salvage a bit more. So this was a very nice trade. But Merc is more volatile than you would think in the beginning. Yes, and earnings watchers showed that basically in the historical data.
We have a question about calendars, which I guess is also for you, Christopher. on calendars where we try to benefit from the increased volatility before earnings. In your experience, how much time before earnings do you enter the trade? Thank you very much.
So as short of time as possible, not necessarily because the AV goes even up even further, which it does, but because I want to be centered, right? So for example, I took the trade that I showed before, actually like 2 hours after market close, after market open before. Ideally, I wanted just before market close, but I didn't have time that day, so it's fine to even be earlier. But the Merc moved from, I think, 112 to 113, 114. So by the end of the day, before even earnings, the stock price might be somewhere where you don't want to have it. So for these kinds of plays, mainly the last minute, well, maybe not the last minute for the also for the spreads, but within the half an hour before market close, before the earnings event, I put it on highest AV, but also mainly because the stock price is where I want it compared to my position.
Anyone wants to add anything on this? If
There are
not, we will go.
strategies that involve putting the calendar on 3 weeks before earnings to attempt to take advantage of the IV rush, similar to buying a straddle the day of. But that requires a different set of modeling tools. And it's probably a longer discussion than we're having now, but those trades can work. But if you're interested in that, I would look only at highly liquid stocks, so Mag 7 and things in that range, because otherwise you're going to get killed on slippage.
Yeah, and also with calendar structures, there's always the model, and then there's reality. Generally, you can say, we put on a calendar, it's actually positive Vega, but IV goes down and the calendar wins. How is that possible, right? And there's always a difference on the different times and different strikes as well, how delta and gamma reacts, but especially how IV, volatility, VOMA, and so on react a lot. Generally speaking, the further out in time, the more muted the reaction is, and the one that's closer in time and closer to the strike, the more volatile all these curves, especially the second order Greeks, are. And one thing is trying to understand it in theory, and you can take all the modeling and push all the sliders up and down and see how that moves. But the other one is just seeing that in practice and how the market actually moves and how the market prices it in. Because at the end of the day, IV is just means what the market is willing to pay in addition on top for that option, and that doesn't have to respect any model. It's just how the Black-Scholes and others tend to spit out the additional price of those options at the time, right? So again, this is why I actually like to play it on earnings, because it's just an accelerated market to get this experience in.
There is one question in the YouTube chat I will take in, even though I said I will not take questions from there. That's for you, Christopher. Do you use double calendars for IV crush effect?
I have done it, but I tend not to. Coming back to, I like to reduce the number of legs. So double calendar, again, double the legs, double the fees and commissions. It gives you a wider tent. Basically, instead of one calendar, you put two. I do that a lot in other weekly trades, but not so much as around the earnings. It flattens, goes down with the max profits and increases the fees. So I have done it before where I really wanted to play it, but nowadays I have enough things on my list of possible trades that I just basically cherry pick exactly what I want to trade, which is what I described before. And double calendars that don't really tend to do much for earnings.
We have only 2 questions left, so we're gonna wrap up soon. They are from Henry. Is it very reliable to look at gamma exposures of the market makers in the stock? How reliable is the gamma flip point? Thanks. Guess you can start on that, Daniel.
Yeah, as I said before, basically gamma reaction levels and delta exposure is very, very helpful. Day trading or swing trading or whatever kind of trading you do, earnings trades, you have to understand is the situation show the secondary filter. It's an important filter, but a secondary filter which will kick in after the IV crushes. It is reliable in general, but with earnings, it's reliability starts again after the IV crash happened in the first couple of hours. And then you asked about the flip zone. The flip zone doesn't basically predict reversal. It just tells you where maybe the move can be dampened above the flip or amplified below the flip. So above the flip, you might have chop, pinning, mean reversion. This is good for short volatility. Below the flip, we see squeezes, trends, sometimes crashes. And basically, yeah, it helps to know these things. And but if you want to keep it simple, you don't want to keep the trades on longer. Like you have seen with the others here, we try to take our trades off, look too much at losers. Use it for calibration mainly. And if you take out the trades in the first 15 minutes, first up, liquidity has come back, then you don't need to worry about that. Just have it in the back of your mind where things can happen and calibrate accordingly using your program, or just use the options chain, and you will find basically the solution you're looking at.
So do you mainly use it as a tool to pick your strikes for your strategies, or also to decide whether you actually want to trade it or even change the size?
It depends on the stock. The very liquid stock, basically, it's a secondary filter. Basically, it might invalidate a trade or might reinforce a trade. So I avoided some trades. And basically, the positioning showed basically that we would be maybe amplified for a larger move, basically. And but it helps me pick the strike, yes, too, and it helps me manage, basically, especially on the other day. This is something which I told you. If you just do the regular trades and take off your trades, you don't need to do that. But let's say I find a favorable stock and I do 10 contracts on it. And then I will take out 25% or 50% very, very fast. If I see they are winners, and maybe the next 25% after some time, and then I will leave runners or adjust something. But this is what I do because I do it with all the other things. If I can give advice, just put on the trades as a pack, like Christopher said, and take it off as a pack. Don't try to stick too much with losers or look at them. There were losers when you looked at them before because you have accepted loss. This is what Eric said. And if they become winners, be even happier, do something good for yourself or for your loved ones, and be happy that you're in your curve of consistency.
What do you? I'm sorry to hijack, but that is very interesting. What do you think? How much time do you have to spend looking at like this additional correction in terms of GEX data and maybe also options flow? Because I see a few people that have a lot of experience, a lot more experience than me, that use GEX to I think great effect. But every time I look at it, may that be for some SPX stuff or for earning stuff and also the option flows, I see a lot of information that doesn't give me a lot of edge. Is it because I need to spend a lot of time understanding that to actually do that? Because for me right now, it seems that I have to spend so much time learning that the return on the time investment for me is not really there to learn it as much. And I'd rather just put on more trades to get my statistical EV out.
It depends. It depends. Basically, for me, it's combined things. Earnings, as I said, is my volatility trades shifted from Theta to volatility. And then basically, if you trade, basically, I'm in the move. Plus adding the volatility. I've learned all that stuff. That's why I have to come from the other side to understand your question. So yes, if you take a lot of trades, you don't need it. But I believe if you understand that these things, market behaves, what market does, basically, and how it behaves live, and basically it will help you with all the other trades. Because let's say your earnings just 20, 25%, if you're not experienced, or from your portfolio of not investment, we don't about investment, about trading. What you do with the other stuff. Let's say you are basically premium collector, what a lot of traders are. You will trade VRP, you will use NVRP and the Z scores and IVZ to see which regime you are. So this helps you. Then you have to look at the expected move. Yes, something you do with the earnings, but in order to make this even better, you will want to know what the market is doing, how market makers will need to react. Or if you understand these mechanics, at least my belief, you can manage all your other trades better, and why not use it then for earnings? But I'm with you. I spent as little time as possible, so I created my own pathway. I've worked my way through all that stuff, understanding that stuff. So for me, it doesn't take much more time. So let's say I take a data pick from Earnings Watcher. This is something I will just take a little bit. If I look at something else which is more exotic, or I don't see the edge right away on Earnings Watcher, but pops up due to other factors, I would spend max 10 minutes on that. I have everything set here. And exposure. Sometimes I will just look at the options chain. Basically, I will be honest. Most of the time, if I'm really in a rush, I will look at monthly Q and look at the options chain, and that's it for me. And in one of my brokers, I have coded my own scripts and all the things there in one line, and just look at it. And I'm doing a lot of trades. I know what to do, but not only for earnings, but for all the other stuff. It's something you do and you get into, and time in trade. This is the important thing, but also time, lifetime. For me, basically, it's not only time in trade, but how much lifetime do I spend with something? And in the end, we don't have enough time. So if I can spend maximum 5 minutes on planning a trade, the thing. And most of the trades have factored in the max loss, so I'm good to go. And I would have orders open and only adjust or jump into things if I really have time, which I mostly don't have. So everything is on automatic.
I have two things to add on that, John, if I might. I'll be quick.
All right.
One is that there are a lot of gamma services out there, so before you start making decisions on gamma levels, make sure you've found a service that's telling you the truth. A lot of them do very naive modeling and are not worth very much. And there are a couple that are very good. That's one thing. Second thing is with respect to unusual flows, I found that to be quite meaningless, because lots of times someone will be buying a lot of puts to offset some other position that they have, and you can't evaluate flows without understanding the context, and you can't understand the context because you can't figure that out. So I think that could be very misleading when you see people on Twitter saying that someone just bought 100,000 calls on this. You have to take that with a grain of salt because you don't understand what the rest of their position is.
All right, we'll go to the last questions and answer that very briefly. This is also from Henry. I use options to protect the stocks in my portfolio around earnings. What techniques would panelists suggest are best suited? Lately, I've been doing collars with different expiration dates. Any better suggestions? Anyone who want to take a very quick stab on this one before we close?
Don't. That's my quickest. If you want to have the stock, have the stock. If you want to trade the option, trade the options. But if you like the stock and have the stock, and then you pay for the protection, you diminish your return from the stock while not gaining really much value from the option. I think there are very little more institutionalized use cases where it makes sense, which I think is not really profitable for most retail traders.
But I agree with that, but I will say that if you are worried about a decline rather than thinking about protecting your position, buy a put spread so that if the stock goes down, some of that is offset. But I don't think it's realistic for non-professional full-time traders who don't work for big desks to protect their positions effectively.
All right, our time is up. As mentioned before, this live stream was organized together with Earnings Watcher. And there is a discount link that if you want to try Earnings Watcher, you find it on the screen now, but it's also in the description. There is also affiliate links to 2 of the other tools that have been mentioned today, Mentor Q, and also Options Strat that Christopher used to visualize his calendars. But with that, I will say thank you to everyone who watched. Thank you to the fantastic panel for sharing your experience and knowledge. We will organize a new Theta Live in March, most probably, so look out for that. And of course, every Sunday there is a new video interview with the retail options trader. So thank you very much to the panel for great job.